super excited to introduce the oil and gas opportunity to you guys, at least just from the standpoint of understanding what this investment kind of looks like and what some of the returns are and my personal experience doing it. I'm excited because, Casey and I, Massey, the Casey on the left here, have been originally did real estate 15 years ago, and it started with a cold call, and we hit it off probably because of our names, but ultimately it took me 2 years. He wouldn't let me do a deal for 2 years. I said, I got this money, I want to buy multifamily, and he's like, I am not putting you in the wrong deal. 2 years later, he goes, I got a deal, this is the right deal. It was way outside of my budget. I said, I don't know. And he goes, this is the right deal, figure it the fuck out. And he was absolutely right. And the reason I tell that story is because he never put me in a bad deal. And the reason I did is because I hated dealing with management companies, I hated dealing with tenants. He goes, what do you think about oil and gas? I said, well, when the oil sign in my car goes off, I have to get a new car. That's about all I know about oil and gas. That's about all I know about oil and gas. He goes, wait till I get this deal. And so I started in 2021. I think we're going to talk a little bit about my direct investments in oil, but over the last 4 years, I've started to understand exactly what it is. Most importantly, the two big things for me is what is the return and how much am I saving in taxes, right? So they're going to talk a lot about that. We're going to start at a 50-foot view and then dial it in a little bit more detail as far as like what an actual investment looks like, how it works, and then if you want to get involved, what that could mean potentially for you. So again, I want to just how I met you guys, not just like random people. I've known these guys for several years now. So without further ado, Casey.
I've owned and dealt in pretty much every asset class within there. That's from multifamily, storage, industrial, office, retail. I even have a couple car washes. They're a huge pain in the ass. They do make a lot of money, but they're more of a business, which we'll talk about in a little bit too. But about 5 years ago, I was feeling some pressure, if you will, with regard to getting deals done. And that was because a multitude of things, but the biggest being cap rate compression just continued to occur. And deals are getting harder to find, and I couldn't make any money, or my clients couldn't make money. And I was getting beat by guys because of the competition. And for me, I have a disdain for paying anything in taxes, and I'm a cash flow guy first. So anyway, not that I don't like appreciation, but Oklahoma in general, where I deal most of my stuff, is a cash flow. It's more of a cash flow focus, where I know California, a lot of guys buy here for appreciation, and you may not have cash flow. But in general, I'm cash flow first, tax mitigation, maybe tax mitigation's first some days, and then appreciation's after that. So I've transcended into oil and gas. And what I want to do here, you can be an operator, you can buy minerals, or you can do what's called non-op, non-operated oil and gas mineral working interest. And the best way to describe that in a simplistic manner is you are able to share in the revenue and expense of an oil and gas well without the operational, legal, let's see here, involvement or management or responsibility or liability like an operator would have. And some of these we kind of went over, but again, superior tax benefits, typically on what's called IDC, they have up to 85% of your first year write-off. TDCs are amortized typically over 7 years. Probably better right now, some of the tax changes happen that you can now accelerate depreciation. And there's also a perpetual depletion allowance until it's depleted of all the income that comes from that well. The first 15% is not taxed. But we only work with quality, what we call top tier operators. So your first year tax saving is $36,312. So for a $125,000 investment into an oil and gas deal, again, these are round terms here, it's about a $40,000 tax hit. Then my at-risk investment then is only $80,000, $90,000. The evolution is what we're looking at right now is a combination or a merging, if you will, of all the existing cash flow assets that always has the existing cash flow base set now, and then the next iteration, which is just continue to grab more working interest and build a larger single fund. So let me describe this to maybe answer your question. So working interest by nature is passive or is non-passive, right? So there's a way we get around the the exit clause, if you will, to be able to offset all of your non-passive income. So, yeah.
And then has it been audited? Has it been tested?
Oh yeah, this has been around for years and years and years, and Keystone or Casey can probably get more into that depth with far as legality. But yeah, this has been, I would say most of these tax laws were created, I hesitate to say 100 years ago, but to induce people to, to exploratory oil and gas development. So 99% of the stuff we do is near-term development. So we are buying as close to the drill bit as we can, and time frame wise too. So these wells are either permitted, the legal process has started. So this is not, we're not sitting on dead capital, if that's what you're asking.
So another de-risking measure is, so this year I got a deal in place with BP, so we hedge now directly with the counterparty. Some companies use brokers and right, but if we can do it, then we will. And so it's been a huge driver for us. I have oil hedged through 2026, and I don't have any gas hedged yet, but I probably will come October.
And the thing about hedging, think of it like this, it's an insurance. Okay, you're locking in your base price. You're not really trying to make money on it. It's an insurance policy of, hey, if oil goes down to $50, well, we're locked in at 65, right? And if it goes up to 70, we're still at 65 on the percent that's hedged, but we still have upside on the percentage that we're not hedged. And so we'll be hedged anywhere from 50 to 70% to give us that range for the upside, but then protect the majority of it on the downside. So mitigation, what are the biggest risks, right? If I'm an investor, that's what I want to know. I want to know, what are my risks, okay? One is area, right? We talked about that. Hey, where are these wells at? Are there good wells around it, right? We don't want to participate in a well where there's not good wells, good data around them, okay? Second one, okay? We talked about price, okay? One of the things that we do when we run these economics is we'll run case scenarios based on different pricing, okay? So we'll look at it and go, hey, today's pricing is X, and there's what they call a 5-year strip price. So there are projections of, hey, here's where prices are going to go for the next 5, 10, 15 years. We'll take that number, and those change daily, actually, believe it or not, but we'll take those numbers, and then we'll reduce it by 10%. What's that do to our economics? Okay, so that's how we're trying to de-risk price. Production's a big risk. All right, yeah, these 4 wells did this, but what if this well's not as good, right? How do we manage that? So kind of same thing. We use the 10% rule. We'll drop the initial production by 10%, and we'll increase the speed at which that curve falls another 5%. Okay, so we're mitigating both at the same time. Hey, this well is 10%, it's not as good as the other wells by 10%, and it falls off a lot faster, okay? So then we run it with that scenario. Hey, does it still work? Does this project still meet our criteria? And then drilling and completion costs. Things happen, right? Yep, and here's the results that we're looking for. We're looking for a minimum 15-20% internal rate of return, 3 to 5 years, but as Casey said earlier, we're really looking, if it's 36 months, if it's 3 years, it's really teetering on the edge of whether we want to do that project. We're really looking for 24 months.
It says 35, we won't do a deal that has a break even beyond 36 months.
Yeah.
The evolution is what we're looking at right now is a combination or a merging, if you will, of all the existing cash flow assets that always has the existing cash flow base set now, and then the next iteration, which is just continue to grab more working interest and build a larger single fund.
I want the tax return, I want the gain, but all the nonsense that goes along with it, I'm not really interested in that. So the fund was what kind of one of the things that came about from that. It's like, hey, make this easy so I don't have to deal with you know, monthly anything really, right? Like,
Just get a K1 and a check, you know, and so, and we can do that. And so, but for us, it's, you know, more about, hey, giving feedback and what the ideal fund looks like, then, and then we'll just structure it that way. He's received about 70% of his investment in 10 months, and it'll pay out in probably 12 months, 13 months. But this is what that looks like. So this is over a 10-month period, by the way.
Right.
So this is, you know, I think you have $500,000 in that deal, and I'm maybe 12 months. He'll have capital recovery, and it's perpetual cash flow after that. Like that's how it works.